Sanibonani, Dumelang, good evening and welcome to the Monday edition of the Private Property Podcast. I'm your host, Zama. I hope you've had yourself a great weekend. You're able to stay safe, sanitized, and of course at home as much as possible. Well, we're back on the Private Property Podcast to bring you all things relating to property. And to kickstart our week, we're looking at something that I know a lot of us as landlords probably struggle with, but always have to deal with. And that's, of course, taxes when it comes to our rental properties. But before we get to this evening's conversation, of course, we always have great content for you here on the Private Property social media platforms, whether you're watching us on YouTube, on Facebook, or on our Instagram page. Welcome to you at home. And if you're watching us for the first time, then do make sure that you go back on some of the great episodes that we have brought on your screens. And some of the other programs that you can look forward to on our screens is, of course, the First Time Home Buyers Show that comes every single Wednesday at 7:45. And that's one that you do not want to miss if you're a first-time home buyer and still, feeling a bit overwhelmed by the process of buying that first home. I know a lot of us have been there. We know exactly what you're going through. And if you want to hear from other people who've been there, share their experiences about their journey of buying their first property, then do make sure that you tune into the First Time Home Buyers Show. And for everybody who's got green fingers or ambitions of feeding us as much as possible, then we bring you the Farming Podcast that is every Tuesdays and Thursdays at 1 p.m. right here across the social media platforms that we have at Private Property. That's, of course, whether you want to do small-scale farming or big-scale farming, it doesn't matter. But if you ever have an interest in agriculture, that certainly is the show to start and really get an insight into what it takes to be a farmer. And we never leave you alone over the weekend. I know sometimes, so many things that happen over the weekend. We'll also bring you the Developers Show, where we profile some of the best estates that the country has on offer. So we always have a lot on offer for you here on Private Property. If it was a Sunday meal, we'd call it the 7 Colors meal. That's just how much they have for you on offer. And we always want to hear from you, of course. If you have any suggestions of other content that you'd like to see us having on our screen, on your screen, or rather even it's our screen, because I also watch the other shows, then do make sure that you drop us the suggestions down here below. We love hearing from you. Well, one thing that you can certainly look forward to in the Private Property Podcast social media platforms is a great competition that we're going to be running. I know I've been hinting at it. Well, you're going to have to stay put just a little bit longer to find out more about it. All I can say is it's going to be big. You do not want to miss it. You want to stay glued to your screens, and it's not going to be only a once-off thing. That's all I can say right now. And to get us started then to, on our conversations, and this one is really mostly for the landlords. So if you already know that you have a rental property, then this is the podcast for you. Whether you are married in commuter of property, or perhaps you have an antenuptial contract, you want to find out how it affects your taxes, especially if that property is in your personal capacity. Want to look at repairs and maintenance when it comes to SARS, and also look at the importance of record keeping. I'm sure a lot of us probably don't do a great job. And I say us because I know I'm not that great at it either, but this is something that you want to be great at. Well, that's some of what you can look forward to on this evening's show here on the Private Property Podcast with myself, Zama. And to get us started with our conversation, I have somebody who needs no introduction. We've had it before. She's the guru when it comes to helping us navigate our rental income taxes. And that is, of course, Barbara Mundell, who's the founder of Your Money Life Coach. Barbara, good evening, and thank you so much for joining us again.
Hi, Zama. Thank you so much for having me.
Barbara, it's always so great talking taxes with you because, as I always say to our listeners at home, I do not like taxes. And I'm sure a lot of us don't. And I also just don't quite understand how to do my own taxes. And I always, talk about how if the government wanted me to know how to do my taxes, they would have taught me this in varsity, but it wasn't in any of the classes. So in my head, it's like, it's that thing that kind of isn't important, but of course it is important. And it's particularly important if you're going to be a property investor and a landlord. And so, Barbara, I actually want us to probably, look at the landlords who are still, let's say, relatively in the earliest stages of their property portfolio. But before we get there, perhaps just give us an overview of how we should be thinking of taxes when it relates to our rental properties.
Okay. So the first thing you should take into consideration with your rental property, you don't pay tax on the gross rent. You can deduct any of the expenses that you incurred in the production of income. So that's the terminology from the Income Tax Act. So basically what that means is all your rental income to be declared, all your relevant expenses that you can deduct, and we'll go into that as a bit into a bit more detail just now, and then you get your net profit for that period. So that is generally what you pay tax on. So before everybody gets a heart attack and think you pay on the gross, no, that's not the case. Then it depends on in which structure you bought your property in. So did you buy it in your personal capacity? Did you buy it with a partner perhaps? Did you buy it in a company? Did you buy it in a trust? And that's also then going to depend on how that rental property income will be taxed. So if we stand still, and you mentioned marital status briefly. So as an individual, you then pay tax on your net profit from this rental property. But what most people forget is when they are married in community of property, that is a joint asset, irrespective in whose name it's registered with the deeds office. It's a joint asset in terms of that estate. Therefore, both husband and wife, or nowadays even wife and husband, whatever your partner, is reliable for those taxes, half of whatever the net profit is. So when you prepare your tax return, if you're married in community of property, SARS asks you a little question there: how are you married? If you tick yes in community of property, you actually have to put your spouse's ID number there. So it's not something you can hide away from. And don't try the clever trick of saying, I'll just notice that I'm married out of community of property, because trust me, SARS knows they talk to home affairs. So there's no getting away from that one. So it's very important that if you are married in community of property, or where you are married and the property is in both your names, so 50-50 partnership, even if you are married ANC, then it's still half declared here, half declared in the other estate. One thing that people also confuse there is when they've got the accrual. So if the property is registered only, let's say, for example, in the husband's name, but they are married ANC with accrual, that does not work the same as in community of property. So you're not going to declare that full or that profit half in your spouse's name, because that works differently. And when you one day get divorced or die, then that gets worked out in terms of the growth of the asset. But the actual income production of the asset is not affected when you're married with accrual. Then if we move on to a partnership, that works similarly to being married. Half of the profits, or however the partnership is structured, if it's 80-20, that amount of income and expenses is directly then declared by the respective partner. If you are very clever and you are setting up rental properties as an income generator for you in a company structure, you've got a bit more leeway. You can then decide how do you want to structure your property profits, where does that want to go. If you want to declare some of it as a salary from the company or personal capacity, you can then work with that taxes and see how to optimally pay the least amount of tax. Remember, as a company, you pay a flat rate of 28% tax, whereas as an individual, you've got a sliding scale of tax that you pay, starting from 18% to 45%. And in a tax, you pay 45%, in a trust, you pay 45% tax, unless you use the conduit principle to which you distribute to the beneficiaries of that trust, then it gets taxed in their individual hands. So there's quite a big structured discussion on the taxes and where they are paid.
And I'm sure, Barbara, certainly for a lot of people who are watching at home, thought, okay, this is quite a lot, because you're not only considering, the rental income by itself, you're also having to think about whether you're married in community of property or not. I mean, you and I, spoke off air, and I was saying to you, I never even thought about the tax implications of a rental property in the event where you're married in community of property. I never have to think about it. I'm unmarried. And so that has actually never even occurred to me, that taxes would, be slightly different in the event where one is married, regardless actually of how you're potentially married and the considerations that have to be made there. So I think for me, that was probably, something that was very fascinating. Let's then maybe stay with the, a little bit with people who are married, because I think it's one of those things when you're unmarried, I think it's relatively easier to kind of manage, taxes and even rental property taxes. Perhaps you work with a tax practitioner, because I always urge people, and we always say it here on the Private Property Podcast, work with a trusted team of professionals, especially if you're not a subject matter expert in the particular activity that you're doing. So sometimes you'll work with attorneys, you'll work with conveyancers, you'll certainly work with quantity surveyors, engineers, and so on and so forth. So it's so important that you surround yourself with the right team that's going to help you navigate your property journey, from buying that first rental property to the day you decide to probably buy a block of flats or even build an apartment block. It's so crucial. So Barbara, I mean, if you look at people who are married, whether they're married in community of property or they've got an international contract in place, what tips would you give them about when it comes to the taxes, or declaring taxes that relates to their rental properties?
Okay, so first of all, what most people make the mistake is, if they do have a rental property before they get married, and they do then get married in community of property, they then think, well, it was my asset before marriage. So unless that specific rental property was excluded from your communal estate, and that can only be done via one or two ways, literally a contract between spouses before you get married. So you can't now after the fact go, yeah, but I actually want to exclude it. It has to be before you are married. And then the second way is if it was an inheritance. So if you inherited a rental property and the person who you inherited it from, their will specifically stated that it is excluded from communal property, then that is excluded and the profits is yours and yours alone. But often people, especially younger people nowadays, they start out single, invest in property, buy the property, rent it out, and then they do get married in community of property, and then they realize, but now what do I do? So getting married in community of property is not about how much you love your spouse. We all love them to bits, otherwise why would we marry them? And it's not about foreseeing that, I might divorce him, or it's not about that. It's about the technicalities of your overall estate and financial planning. And it forms, rental property forms such a crucial part of it, because it also depends what you want to do with that property. Is it something you just want to generate short-term profits with? Is it something you want to keep for long-term, that you want to keep in the family line? If like I said, if it's inheritance that you want to pass on to generations, that conversation becomes very different. And I urge people that before, if you are thinking about getting married, while all that butterflies are in your tummy and you're feeling so excited, just consider having a chat to any financial professional about the consequences of your marital contract, because there's a lot of things they will highlight to you that you need to take into account in your planning.
You know what, Barbara, I think as you were talking, I was actually low-key getting premarital advice. I mean, if I ever consider walking in that direction, because I think it is one of those things that we sometimes don't think about, especially in the middle of, in a serious relationship. It goes from dating, getting engaged, and then certainly if a lot of Black families, you go from lobola, and then you're now, so mabo, and then it's marriage. And more often than not, in between there, we don't really sometimes talk about, I have, these rental properties, or these are the assets that I have. How do we best structure, our lives? It can easily become an uncomfortable conversation for some people. I mean, I'm very big on talking openly about money, talking openly about assets. I mean, I actually often, say on my Twitter page that I wherever my future husband is, I hope he's growing his NAV, and because I'm doing the same. So I think it's one of those things where not a lot of us are comfortable about talking about these things. I joke that, listen, by the time we're on the fourth date, we're taking out our balance sheets, we're understanding the state of our finances. And I mean, I half jokingly say it, but it is one of those things as millennials, and especially millennial, Black women, where we are buying properties before we get married, or before we get into a serious relationship. And so by the time your future husband, now soon to be actual husband, comes along, that's a conversation that needs to be had. And it could very well be that your partner also has properties or doesn't have properties. So you do need to have it because you want to structure the marriage in such a way that the estate is also very well protected. Because as you were saying, Barbara, I think, and that's one of the things that I think sometimes people don't quite, take into consideration, that when we talk about having, looking at your marriage contract, perhaps rather getting married with an international contract in place, as opposed to, for example, in community of property, it's about protecting yourselves as a family. So almost think we're going to be together forever. How do we then protect ourselves forever, right? Because life is long, so many different things can happen. One of you can lose their jobs, both of you can lose their jobs, somebody's business can go under, all these different things. So what kind of protection measures are you putting in place to ensure that financially you're going to be able to weather whatever storm life throws your way? And I think that's probably one of the best ways to look at structuring certainly your marriage before you get into it, and having that conversation early on. And then the big thing, have it on date 2. I mean, I joke about it, but I think date 2, like, what's your credit score? Let's sit down and have that chat. And that's probably one of the best ways you can just get it out of the way as soon as possible. But we're going to go for a quick break. We're going to come back. We're then also going to look at other matters that we wanted to explore this evening. We are, of course, talking about managing your rental property and associated taxes, and really better understanding the tax implications of our rental properties, regardless of whether you've bought your property in your individual capacity, you've bought it in a trust, perhaps you've even bought it in a PTY. This is one of those things that so many of us probably struggle with quite a bit. I know, and I'm very honest with this. I don't really do taxes. I have somebody who manages that for me very well. But this is one of those things that if you have rental properties, you're always going to have to deal with very regularly. And of course, if you're watching us at home and you've always had that burning question when it comes to taxes in your rental property, do send it through. I also want to hear from you at home, and we've been speaking about it quite a bit in the past few minutes. If you are married or perhaps single, do you have that conversation? Did you have the conversation with your partner about your assets before getting married? Perhaps one of you had a rental property, perhaps both of you had a rental property. Did you guys actually have that conversation? Or if you're currently still dating and you know that this is the person I'm actually going to probably marry, are you having that kind of conversation of, listen, I actually have 2 investment properties. I know you don't have any investment property, or you don't even live perhaps in the house that you've bought, you're renting. How can we best kind of manage our finances? How do you go about initiating and having that conversation? I know I probably have tips. I would love to hear the tips, and certainly hear from you at home how you navigated that conversation, which can be quite uncomfortable sometimes, because I think different people can get very easily uncomfortable. But do share with us how you navigated that conversation. We certainly want to hear from you. We'll be back just after this. Welcome back to episode 165 of the Private Property Podcast. I'm your host, Zama Khumalo. It's the Monday edition of the Private Property Podcast, and we're quite excited to be back from the weekend. We're talking about something that so many of us as landlords are going to have to deal with at some point or another. That is, of course, managing your rental property and associated taxes. I'm in conversation with Barbara Mundell, who is the founder of Your Money Life Coach. Barbara, before the break, we spoke quite a bit about marital status when it comes to our rental property. I did say I want to hear from viewers at home about how they had that conversation or those conversations, because I also think it's not a one conversation thing, it's multiple conversations when it comes to your assets before you get married to somebody. So if you as a woman, or certainly you as a man, have a rental property or rental properties, were you able to have a conversation with them, especially where they're perhaps in your personal name? Were you able to have that conversation with them? How did you bring up that conversation? And really talking about money and making sure that you structure your estate as a unit as efficiently as possible. We are taking your questions and comments at home, whether you're watching us on Facebook, Instagram, or YouTube. Do send them through. And I see we've got a few questions here from our Facebook page. I'll start with this one, and I love it because it's a great segue to where we're going and taking our conversation, Barbara. This one is a question from Delana Skoltz, who asks, "Hi, Private Property, can I deduct the following from my rental income before taxes? The bond repayment, the levies, the municipality repairs on bond, and he says policy." So, and this is what you mentioned briefly early on in our conversation, that you don't get taxed on the gross rental amount. So if your rent is 6,000, you don't get taxed on the 6,000. There are certain expenses that you would typically include. So essentially, what are the kinds of expenses, Barbara, that one would include before we'll say the profit portion is then later taxed?
So I think let's start off with the biggest one by far, and that is your bond repayment. Most people are under the illusion that they can deduct the full bond repayment. Remember, your bond repayment is structured with a capital portion and an interest portion. Now, the capital you can't claim because that's not an expense. It's a future thing that you're building that asset. So you can only deduct the interest portion that you've paid. And it's quite easy to get that from your bank, because at the end of the tax year, which is generally for individuals at the end of February every year, you can just give your bank a call or just pop them a mail and ask, "I just want the bond statement showing the interest paid for the last tax year." The banks do that, so they hand that out to clients very easily. They have to report that to SARS as well. So they do have a standard letter that they can give you to show you the interest that you've paid during that period. So that's by far the biggest thing that people get confused. They think they can deduct the whole bond repayment, which is just the interest portion. You briefly spoke about repairs. Yes, any repairs and maintenance you can deduct that from that income. Now, people often get repairs and maintenance confused. So changing a globe is not necessarily repairs and maintenance. So SARS defines repairs and maintenance as repairs to the structural, cosmetic, or furniture and fittings. So if you've put in a new light, that is repairs and maintenance. Changing a light globe is repairs and maintenance. But changing a light globe at your personal home, that's not repairs and maintenance that you can claim. So that's very important to understand what repairs and maintenance, and the reason behind that is that's probably the most audited thing from rental income, because people do take chances. Anything else?
Robert,
Yeah.
I actually want to just interject that before you go to the next item. When we look at repairs and maintenance, is there a cap on it? Because as you've mentioned, people probably like to take chances. It's easy to buy, material that you'd say you'd use and work with contractors who'd give you a quote for services rendered. So is there a cap on sort of how much you can essentially declare as a repair and maintenance cost?
So no, there is no cap. If you had 100,000 Rand as a repairs and maintenance for that year, you can claim that full amount back. The key is, though, you must be able to prove that you have repaired or maintained that property. So, for example, we've had clients who try to do a whole warehouse of paint almost into a property, and then the SARS auditor walked in and the paint was peeling off the walls, the place was half tiled. So that's the kind of, you need to be realistic, and you need to know that SARS, when they do sniff, and they've just got a way of knowing when you're
they're the most efficient government department. They get their money. Like, if anything, I wish every other department were like them. They do that. I mean, I get audited all the time. So, and luckily I always have a clean audit. But they have their money on the pulse, their finger on the pulse rather.
Yeah, no, they definitely do. So as long as your repairs and maintenance within reason, while we're on that, so if you do have let's say you bought this place, you are renovating it totally because you bought it at a bargain and now you're renovating it completely. We must also distinguish between the capital expenditure and the actual normal improvement. So if you build, that is deemed as a capital expenditure, and that will then come into play when you sell the property for the capital gains tax, and we'll touch on that a bit. But if you do the painting and retiling and making the cosmetic changes to that property, you can claim that as a deduction. What SARS might do, because you are likely to have other income as well, is they might what they call ring fence that loss. So you can have an assessed loss going on year to year, but SARS will then say, well, we are going to allow you this loss, but we can't deduct it against any other income apart from rental income. Because that's another thing people always do, is they buy a property, invest a hell of a lot of cash into it, and then try and claim that as a deduction of all their income. SARS will ring fence it and say you can only deduct this from future rental income.
See, when I say that SARS is efficient, they found every imaginable loophole to also make sure that they don't get to pay us back. Another question here coming through from Facebook is coming from Colin Lee Collins, who says, hi, private property, when your tenants perhaps do not pay the municipality account, can you ask the agents to use the deposit to pay the account?
So that's going to depend on your rental contract and what your rental contract says about the deposits.
Typically, I mean, I'll get in here slightly, Barbara, because I like the fact that you point to the the lease agreement. You're legally not allowed to touch the rental agreement for any purposes. In the event where you want to use the deposit amount, I mean, you can't touch the deposit amount for any purposes. In the event where you want to tap into the deposit amount for whatever reason, then you essentially have to write an addendum, so almost a new contract, saying that you're going to be utilizing the deposit amount, and this is what you're going to be utilizing it for. And sometimes it might be that you're only utilizing a certain percentage of it and not necessarily all of it in its entirety. So as a landlord, you can't decide sort of unilaterally that you're going to use deposit money for whatever purpose that essentially arises. And in the event where something does happen during the course of your relationship with your tenant and there's a need to tap into the deposit amount, and we saw this happening this year when there are certain instances where tenants couldn't make rental on time because their income was affected due to the effects of the COVID-19 crisis, whether they had their income completely affected and they weren't being paid, or they were being paid a certain portion. You saw that, for example, TPN with SLR Incorporated had the rental rent pack, essentially, where they also had that contract where it was almost very standard. As the tenant and landlord, you had to sign that. So that was the deposit utilization contract. So I think currently, certainly do explore that. They do have it. It's still freely available online if you want to tap into the deposit. But as I said, it's not an automatic thing that you can do. And I think when it comes to the municipal account, municipality is the responsibility of the landlord. So there almost isn't, I don't know if lease agreements that would, pass on that responsibility to a tenant. But as far as I'll say the legal sort of responsibility, paying your municipal account would typically be a landlord responsibility, especially because it's in the landlord's name. So it isn't necessarily something that a tenant would be liable for, unless, of course, you may have structured the lease agreement slightly differently. Maybe it's a long-term lease, and that's something that you and your tenant have made provision for in the lease agreement. But do go to the TPN website or the SLLR website. They've got a really great lease pack that you're able to utilize for free in the event where you want to use the deposit. I think they also explain it quite nicely around what you can and cannot do. But because I see we're slightly running out of time, Barbara, and we haven't gotten to another area that I know you and I want to get to, which is around record keeping. I think when it comes to record keeping and SARS, I'm not that great at keeping records. Very glad that we can now at least put a lot of things on the cloud. So sometimes I know it's somewhere on the cloud, but I haven't structured it nicely enough to be able to easily access it. Why is record keeping so important when it comes to submitting our taxes?
So the first thing is you have to keep records 5 years after your assessment has been finalized. So it's not 5 years from the date of that actual record. It's 5 years from the finalization of that assessment. And the reason for that is the law allows SARS to go back in any of those 5 years and say, we are now auditing you for whatever purpose. Obviously, they have to have some sort of reason. So if something is suspicious in this year's tax return that they've picked up, they might then go back. They're not just they don't have the time to just go willy-nilly dig back in 5 years. But when they do, there's usually a reason, and that's why they need those records. So record keeping, you have to keep it for 5 years. Cloud is wonderful. There's no law that says it has to be physically paper. You can scan in your receipts, keep them all on a drive. But the most efficient way that I've noticed that when dealing with SARS is if you provide them with a spreadsheet of the dates, who you paid, what you paid them, and what it was for, they generally say, well, okay, we'll ask for 1 or 2 of those invoices in that record that you've provided, just to verify that they are real records. So yeah, they will very seldomly request for all copies of all your records. They will ask for a summary and then nitpick which invoices they do want.
I think if anything, that probably reminds me of when, whenever I get audited, luckily everything is already in the drive and my accountant's able to go in and give it to SARS and say, these are the documents that they asked for. So keeping record is important, even for those of us who are not particularly great at admin like myself. I think one of the great things about the cloud is scan it, put it there somewhere, literally have a folder for each property. And I have the different folders for all the different properties, and I'll just chuck everything in there. And when it comes to doing the taxes, then we at least know that it's there. It might just be about trying to put it in order, but I know everything is actually in the folder. But Barbara, I know you and I can talk about this for quite a long time, especially because this is one of your favorite topics. I think as we wrap up 2020 and look ahead into 2021, what tips would you give landlords around managing their rental properties, especially when it comes to the tax implications of their rental properties?
Yeah. So the first thing is, sorry to hammer on the point, is keep record of everything you do. We're lucky enough nowadays that our smartphones can take photos of documents very nicely. So as you say, take the photos, put it into the cloud, and you've got that record. The second thing is also make sure that what you are claiming as tax deductions is legitimate tax deductions. And we've got 2 minutes. I just want to run through the rest of them that you can claim. So if you pay an accountant to prepare your tax return, that you can claim as professional fees. If you had a managing agent, you can claim their fee back from your taxes. The property taxes that you pay, the water and lights that you pay, that you can claim back. Just touching back on to the listener's question, if the tenants pay the water and light or the municipality account, you can't claim that as a tax deduction as well. And don't think that SARS doesn't know. They will ask the tenant, did you pay? Yes. Sorry, claim denied.
I mean, look, they're able to even see it on our bank statements. As much as the municipality sends it to me directly, I then pay the municipality. So they'll be able to see in my bank actually physically paid the municipality that particular amount. So there's almost no hiding that bit, right?
There's no hiding. And then other things is like we said, the repairs and maintenance, and anything that you can prove to SARS was for that rental property in order to gain the rental income. That's the golden rule. So whatever, if you are uncertain of a claim, measure it against that rule. Can I claim this because I needed to do this in order to get that rental income?
That's actually such a great way to look at it, Barbara. We are going to leave it there. I know that we're going to be having you back in the new year. I'm quite excited about that one because it's going to be looking probably at how to best position ourselves for the new year, especially with our rental properties, because I'm sure a lot of us have quite a little bit of those. I see we've got a comment here from Facebook from Delano Scalds who says, if you can please invite an economist to the show, I would like to know for how long will the interest be at 7%, because I'd like to fix my interest rate. Well, Delano, I can tell you this for free. They all don't know. There isn't an economist who definitively knows how long the interest rate is, how long the prime is going to stay where it is. So if I brought somebody who predicts that it's going to stay for 3 years or whatever number of period, they would be lying. If anything, we could probably, and one of the things, and it's because this is something I follow, even when you ask the Reserve Bank governor, even he himself won't tell you this is how long it will stay there, because they do have the meetings and they debate it out. You know, they weigh different factors that inform whether the rate is going to remain the same or they're going to decrease it further. What we do know is we do have room for it to go down. So we certainly do have room for that to happen. And I know that we would have liked in the past 2 meetings for it to go down because we knew we actually could afford for it to go down. But no economist can predict how long that's going to. Listen, if I knew such an economist, they'd be my best friend. And I would probably make purchases just based on what they tell me. But because some of my best friends are economists and, you know, work in very interesting places as economists, I know for a fact that none of them can definitively give us that particular insight. Well, Barbara, thank you so much for joining us, not just this evening, but for all the other episodes we've had you this year. It certainly has been a pleasure. I know that we'll be speaking to you again in the new year.
Perfect. Thank you for everyone for listening.
And that is Barbara Mundell, who's the founder of Your Money Life Coach. Well, that's it from me, Zama and the rest of the Private Property Podcast team on this Monday edition of the Private Property Podcast. Thank you very much for tuning in, for engaging with us. We're always going to keep the conversation going across our social media platforms. So do make sure that you continue engaging and sharing your insights. On my own social media platform, I'm at Zamantungwa_K. Certainly love hearing from all of you at home. Well, that's it from us. We're going to be back on your screen tomorrow evening at 7 p.m. Remember to catch the Farming Podcast with Umbali tomorrow at 1 o'clock. That's something that you certainly do not want to miss. Well, until then, hoping you're staying home and staying safe.
Hi, I'm Zama, and I'm an entrepreneur from Soweto. Soweto's come a long way, from a small township to a mini city of its own. Soweto's got some really nice suburbs, like Diepkloof Extension, but the locals call it Diepkloof Expensive. Orlando is known as the suburb that had the first brick houses built in Soweto. Orlando Stadium for its iconic games between Kaizer Chiefs and Pirates. And most importantly, Vilakazi Street, where Nelson Mandela and Desmond Tutu resided. To the west of Soweto, you find suburbs of Dobsonville and Protea. These two suburbs are actually very cosmopolitan, fresh, young, and very new. Right next door to Soweto, we have our neighboring suburb, which is Eldorado Park. For a little adventure and a little fun, Soweto's got so many night spots, from the News Cafe at Mponya Mall, to your Vilakazi Streets at Kumzi's, to just chilling at Chafpozi just between the towers and having a simple braai vleis Nyama. Something very close to my heart is actually seeing people move back into Soweto, growing businesses, remodeling homes. It merely says to us that Soweto is a growing city. There's way more to this place than what we think. Soweto needs to be discovered daily. I'm so proud to call Soweto my home, and this is my neighborhood.